Good afternoon, ladies and gentlemen, and welcome to our ongoing series of Market Gurus, where you get to meet, understand, and appreciate the lovely talent that is there on the Lal Street, professionals and equity strategists and fund managers who have the pulse of this roaring bull market and are deploying money as we speak. Our guest today is Mr. Niraj Kumar. He's the Chief Investment Officer at Future Generali Indian Life Insurance, and Mr. Kumar manages 15,000 crore rupees spread over equity and debt in Indian capital markets. Niraj ji, what a warm welcome today. Tata Technologies has listed. Nifty is consolidating about above the 20,000 point mark. What an excellent day to have you. Tell us, what do you think about sentiment on the Lal Street, and where do you see the Nifty 1 year from now?
Thanks, Shailendra, for having me here. So yes, of course, it's a great time to really be in. And let me tell you that maybe India, in fact, for last maybe few years, has actually continued to be the bright spot in the whole world, despite all the challenges that maybe globe has. India as an economy has done all really well from the perspective of all the structural growth driver or maybe the macro trend, and has moved maybe from a strength to a strength. So it's really lovely to really see India actually exploring to a new place. Just few days back, we actually saw India becoming moving to in terms of the GDP one notch higher. Okay, and which is really a good insight to have it. So overall, it's a great atmosphere, and that is the reason you are seeing it in terms of the market also. Market has actually been buoyant, especially led by the retail money, and the HNI also has actually been supporting. So it's good time. We actually see good sentiments actually continue to prevail. In my mind, perhaps we should really move at least 15% higher from here. So I'm actually looking at 23,000 sort of maybe Nifty level a year down the line if we really met. Broadly, but the risk would really be a political risk, and we really just need to be cognizant of that. We have in May elections, and that would really be the driving force, maybe where we really shape, whether 15% higher or maybe 20%, or maybe it could also be somewhere around this itself. So some sort of consolidation may happen if we really see some bit of not a very clear majority for maybe whoever the government comes, then it could really have some bit of problem. But otherwise, if everything really falls in place, which is what really as of now market is expecting, I think 23,000 is not really very far from here on in next 1 year.
Wonderful. With that really bullish forecast, let's drill deeper. As I said, 15,000 crore rupees is what Niraj ji mentions. The fresh money, Niraj, what is coming into your corpus? How are you planning to deploy it? And with a bit of a rider, the viewers of Market Today, as also Business Today Television, are very, how should I say, less risky profiled people. We will go with 15% CAGR on the Nifty as far as the upside is concerned. And with that in mind, let's look at fresh allocations. Where are you pouring in fresh money?
So there are pockets in the market which really looks very interesting. So are they interesting? And since you really mentioned that most of your viewer are not somebody who is really looking at maybe a small cap and mid cap and really looking to multiply money overnight, that's the right audience for me also to really have, and I can relate to them maybe more. So broadly, if you really look at last 2.5 year, market has certain pocket of market has really consolidated. I would say 50% of Nifty constituents that if you really look at, or the weight that if you really look at, in last 2 years, either it has not gone anywhere, despite the fact that maybe the number in terms of the earnings would have really gone at least 20-25% higher from where it was maybe 2 years back. Okay. And if I really look at these stocks are either languishing maybe where it was 2 years back, or maybe it could be lower by 20-30% from there, where maybe from where they were. So clearly in some pockets, we really have seen some bit of consolidation. And that's a piece that maybe, okay, I would really say is giving me some bit of comfort, and which could really be the driver for the next phase in terms of the market. If I really need to mention maybe a couple of segments, it could be some of the private bank which has actually not moved the weight, and they have a heavy weight in terms of maybe the constraints of Nifty. They could really be the one. Then you also have certain segment which is either the cement or the capital goods, which is looking at maybe at this juncture maybe certain structural changes in the market. So that could continue to really drive the market on the higher side. Broadly, these are the pockets where I really see a lot of deployment one really needs to do, and relatively should really be give up maybe slightly higher than the market return. There are certain pockets which, as of now, currently I'm avoiding. One could really be commodities. We all really know, okay, US is the cusp of some bit of slowdown that we would really see, and that's a segment where one really need to be a little cautious. Okay, and the other is of course IT. uh, I would say 3 months down the line or 6 months down the line, IT could really looked at maybe positively, but there are uh, 2 and 3 quarters of pain still really left in IT, and that bottoming would really happen, and that could really be the time to basically build the exposure towards IT. So at this juncture, my preference is banks, cement, capital goods. 2 quarter down the line, I would really move towards IT and commodities, but not at this juncture. So that's how I am really looking at.
Wonderful. That's a detailed explanation on where fresh inflows are headed within future Generali India Life Insurance. Neeraj, now let's take it sector wise. You've made your preferences known: private banks, IT 2 quarters later, capital goods, and of course, cement as of now. Let's talk about sentiment and the fact that you address a foreign parent within your own space. What are your overseas counterparts thinking in terms of India? How do they expect you to navigate this fantastic bull run that is unfolding in front of us, probably which has stronger and deeper legs than the previous ones that we have seen? What is your understanding of your interactions with foreigners, especially your parent, when they want to invest in India?
So, Generali is one of the largest entity globally, and since I'm part here, I of course continue to really interact with a lot of people who are basically from outside. And I can really very much tell you that last 2 years, 2 and 3 years, uh, all towards India, suddenly you really see a sea change in terms of their opinion. Okay, some time back, maybe 2 and 3 years back, there were a number of geographies where perhaps people really used to talk and say that maybe perhaps they could really, that those countries could really be better than India. But today, or maybe last 1.5 year and 2 year, whoever you really speak, there is a consensus emerging maybe in most of the talk. India is the destination. You really, what whoever is doing the business really need to be get more focused towards what they're really looking to do in India, and clearly that is very much visible, either in terms of maybe our own entity, which is generally, or there are a number of numerous entities in India which is really looking to set up the shop and really be beneficiary of that next 10 year 20 years sort of the growth momentum that we could really generate. So all structural driver is really in place. Shailendra, if you really look at, I would say in last maybe 15, 20 years, I have actually been here maybe for in this market maybe upward of 20 years. But I would say that maybe if I leave apart maybe way back 2005, 6, when a lot of changes were really happening in the economy. Today, when I really see, I would really more or less would really say we are closer to that cycle. Okay, you are seeing a lot of changes which is actually happening, which can take the economy to a different level. The slow change that we are actually seeing in terms of uh, the market or maybe the environment, India is moving towards a manufacturing economy. None of us would have thought maybe 10 years back that Indian manufacturing space could really get so interesting. Today, you have really best of the car really coming from Indian owned companies. Okay, and that's something which is really a big surprise, which is really emerging. And of course, these entities are far more competitive and far more price conscious than most of the world. So, okay, clearly a lot of things are changing. When you really look at the defense space, a lot of stuff which is happening, we suddenly are getting a lot of capability which is coming on our ways. So, suddenly in last few years, you will really find Indian manufacturing space has emerged far more stronger. Okay.
Okay.
I take it back to maybe 90s or 95 when you suddenly saw IT space was becoming very critical for India, and that gave the momentum for India for next 20 years, 25 years. Today, it could really be the manufacturing space, which would really give that maybe same push to the economy, and we could really be all beneficiary of maybe this maybe over next 20 or 25 odd
Right.
years. So it's a big change, big change.
Okay, Neeraj, since both of us have spent our formative years in Delhi, you intuitively are talking about what my next question is, which is the manufacturing space. Fabulous changes that are coming in as far as the Indian corporate sector is concerned. PLI schemes being rolled out by the government for export sensitive and import sensitive sectors. When you build your portfolio currently or over the last 1 or 2 years, what are the specific stocks or what are the specific micro sectors that you have put in money as far as the broader manufacturing space is concerned?
So we all know there is a lot of things which is happening towards the power as a sector. Okay, some of the space which has actually interested us within the power could really be uh, manufacturing entity which actually supplies to this entity. There is a sea change which is actually happening either in terms of the distribution of the power. The way it was in terms of the metering and the other aspects that maybe you really see. Now, government is more conscious that maybe there has to be a foolproof system where distribution mechanism should really be developed in such a way that we somehow reduces the proliferation in the system. Okay, so we have taken exposure in those entities where we can actually think these entities could really be over a longer period could really be a beneficiary. Then, of course, we are looking at maybe the space in terms of defense, where we really see a big change which has actually happened and is going to happen over next maybe 3 to 4 years as well. So those are the space that we are actually quite conducive, and we have actually built our exposure. Of course, there would be time when some of these exposure really move manifold, and you really need to trim because maybe as we all know, of course, a small cap and mid cap has some bit of maybe euphoria already setting in. Okay, and then in that case context, maybe you can reduce some bit of exposure, but that's part and parcel of our portfolio management style. Whenever we really see the segment is hitting up, maybe perhaps we would reduce our exposure a little bit, but broadly for a long term perspective, this is the space to really be in.
Fair point. And one very quick question before we move to the debt part of the interview. Neeraj, you don't think that defense is overheated at this level? I mean, we've seen stocks like Mazgaon, Garden Reach, Cochin, and so many others, especially HAL, maybe go up 3-4 times. Is this a point of worry or is this a point of inflection?
I would say maybe these segments could really go for a prolonged period of time in terms of consolidation. It could really be 1 and 2 year, but you would not really see a problem in terms of if somebody is looking at this sector because sector is changing for next decade. Okay, there is a humongous opportunity which is going to come on its own way, and hence sector would really perhaps because their stocks has run up much before its time. Some of them could really see some bit of consolidation and maybe which can really happen over 1 and 2 year. But broadly, if I really still have to look at longer term picture, these are not the space which is very cyclical in terms of 1 and 2 year of cycle. This would really go on for maybe at least 7 to 8 odd years, and hence there is still a lot of money to be really left on these names too. Okay, and these segments too. It is just that maybe it has really moved much faster than in last 2 and 3 years. And somewhere you also have to challenge, understand that there is a big change in happening in terms of the return ratio of these entities because the growth that they really have seen and the return ratio, the way it is shaping up, there is a re-rating of those stocks really happening. And to some extent, it is really fair to really expect that. And this is we really have seen over the period, maybe we have seen in many sector where The re-rating has happened because the return ratio, when you really look at these entities, has really dramatically changed. So to some extent, it has really been priced and rightfully too. But of course, some bit of we have really seen in last at least last 1 year, this segment has really moved tremendously and could really be some bit of correction or consolidations, which could really be on card.
Right. And of course, fairly confirmed order books and consistent payment record from the government of India has also contributed to the, let's just say, frothiness and excitement on all these defense counters. Shifting to debt. Neeraj, we are at a epochal move where Indian sovereign debt will now be a part of the JP Morgan index, the debt index, somewhere in the middle of 2024. Paint for us a picture what this means for the economy and how could this move potentially alter India's fiscal balance sheet.
So, Salin, this was something which was long overdue. India has not got its fair share in terms of the global allocation when it really comes to the debt money or the fixed income money. Okay, thankfully, with this inclusion, we would really see India getting the its own fair share in terms of where we should really go. We already started seeing some bit of numbers changing. Last 2 months, we have actually seen a good inflows to the extent of maybe almost 25,000 crore, which has already come in debt market. Some sort of passive money will anyway follow, as we really know that maybe there is an inclusion of the debt index, and India has actually been included. But along with that, because now you really have there is a passive money also would really come to us. There would also be some bit of active money which is already going to come. So all put together, this is really good news for India. How it really helps us? It helps us in four ways. One, of course, government would have really one more source in terms of the liquidity that it can really fund its own, maybe the fiscal deficit. And as we all really know, there is every year government really needs closer to around certain number, and that really would ensure that the interest rate in the system is not really going because of the larger borrowing by government may not really go on the higher side. So clearly, it helps in keeping the interest rate relatively in the system checked. It actually gives maybe some bit of ability for the government also to manage their borrowing. These money coming in the system would really infuse some sort of growth momentum for the whole economy because money would really be available to the larger system, and that could really again help the economy. And the fourth one is in terms of maybe the sentiment perspective. And the to some extent, I would say the stability perspective. If we start really getting some bit of money from the debt as well, what it also does, that today is the problem in terms of the currency also would really get addressed because there is one another source which is really coming in terms of the inflows. So clearly, all this put together, it really works well for an economy like India, which really needs a lot of capital to really grow in maybe next 10 years. Essentially, what we are looking at 6.5% in terms of growth for maybe next 7 to 8 years. And that would really mean the government really needs to continue to infuse capital, continue to really build maybe certain sectors. And hence, this money coming in, of course, JP Morgan index could really have around 25 million of only money. But along with that, there are number of indices which would also really include. So what we are looking at over maybe next 2 to 3 years, uh, at least maybe 100 million of a possibility that we really have, and which is really a big money that maybe one could really look at.
Absolutely. That's $100 billion, if I hear you correctly, on an annual basis, Neeraj.
So no, 100 billion when I'm saying it is overspread over maybe 3 years.
Okay.
Okay, because the one JP Morgan inclusion itself could really infuse closer to around 25 billion. And there are many more indices like such, okay, which would, if I really look at maybe all these indices coming together, it could really be taking the total amount to the India closer to around 70 to 80 billion, which is significant.
एब्सोल्युटली। और हमारी तरफ दिल्ली में, यूपी में कहावत है नीरज जी, आपके मुंह में घी शक्कर, तो वो जल्दी जल्द उसका इंतज़ाम कराया जाता है. दैट्स अ फैंटास्टिक trajectory that Neeraj ji is pointing out as far as bond inflows into India is concerned. In the same breath, Neeraj ji, your view on interest rates. We've seen a pause in the US and a strategic pause which the RBI introduced April of 2023. From there, the run-up has been hugely positive for Indian equities. Do you think we are at the cusp of a rate cut and therefore a bond rally as well?
Yes, it is likely to happen, not immediately. Okay, and why I say not immediately, because uh, there are certain data prints, and if you really look at off late what RBI has actually done in terms of, they have taken certain measures in terms of the counter cyclical measures. Because we all really knows there are certain pockets in terms of the credit, which is really getting some bit of fitted, which is most to do with maybe unsecured credit. And government RBI has on its own part really taken certain counter cyclical measures to really ensure that there is no bubble which actually comes there, okay, or sort of maybe hitting up really happen in that maybe segment. Uh, if I leave that uh, that recent initiative by RBI, I would really say, and including that, RBI has done a phenomenal job in terms of maybe keeping a vigil to the whole system. Uh, of course, Fed has done its own bit, and Fed has really taken a measures of late that they were started becoming dovish. RBI is really became maybe more or less neutral in terms of a stance some time back. Of course, they are maybe more vigilant in terms of their own inflation trajectory. What I would really say that the similar pattern would really continue, or the market could really be range bound for at least 6 months. But when we really move towards the second half of the next year, I my guess is that maybe we would really move closer to around 6.75 in terms of the 10-year, which is currently hovering at 7.25. So I do really see around 50 bips over the year in 2024. We would really see a cut in terms of the repo rate, and that's my stance. I would also say that to that extent, we would really see the 10-year correcting from all the way to 725 and 30, all the way to maybe 675. That's a stance that we really have at this juncture. So clearly, the peak in terms of the interest rate cycle is already done. We would only see consolidation maybe for some time. And as we really move on, maybe towards the fag end of maybe 2024, we would head towards maybe the downward cycle.
Wonderful. So the 625 and the 750 that Neeraj ji is referring to is actually the 10-year bond yield, which is 7.5%, and he's hoping that that's headed towards 6.25%. This is similar to the 10.
Challenger 6.75 next year.
6 points. Okay. This is similar to the kind of fall that you are seeing in the 10-year US bond yield, which, till about 20, 25 days ago was the first thing that every equity person in India and across the world looked at when it crossed 5.5. Thankfully, it's toned down, and that's the reason that you see a rally in the US markets as well as Indian markets. Strategically speaking, Neeraj ji, our friends from the foreign investment horizon have been sort of taking out money, and that's mainly because of the US 10-year yield from India. Do you think they have made a mistake given the strength of Indian equities because of domestic inflows, SIPs, ultra HNIs buying, as also a very strong interest that is coming from the retail side on a daily basis? Your views on foreigners partially exiting India?
I think it's fair on them to really take out money as well. And the reason I would really say, I don't know where the money is actually being deployed. So it all depends on that. Okay. Today, when you really look at maybe, and just some time back when you had maybe a lot of tenure in US GSEC, which was actually giving close to around 5% return, okay, over a longer period of time, without having a risk in terms of maybe the currency. I think it's a phenomenal number to really look at. And the reason is that maybe, okay, 5% US interest rate we have not really seen for last 20 odd years. Okay, and if that is what maybe you are getting opportunity after 2 decades, might as well really build a portfolio around that, because most likely after 2 and 3 years we could really be sitting not more than 2.5% in terms of the interest rate trajectory for US. And if that happens, then you are really looking at a huge return, because current interest rate coming down from 5 to maybe 2.5 sort of number would really mean a lot of maybe mark to market return for them. So, of course, when you really look at from the risk-adjusted return perspective, for them, some of them are they're just really looking at that there are certain other avenue which is also there, and maybe they are just looking at that. At the same time, yes, India continues to really do well. Maybe somewhere down the line when uh, perhaps India would really be out of this political risk, they could really be coming back to the system. Of course, they need to buy maybe 10-15% higher than what we are today. But perhaps that's a risk that maybe they really want to live with that.
And that's the reason why in the initial part of the discussion, Niraj mentioned that his two favorite sectoral picks would be private banks and Indian IT, where you've seen the maximum amount of foreigner selling over the last 6 months or so. Niraj, we are at the fag end of this wonderful conversation. I'm requesting you to paint a picture for our audience as to what, according to you, will be the size and scope and the visibility of the Indian economy 3 to 5 years from now, and as a healthy forecaster, the medium term expectations from markets, again 3 to 5 years.
So yes, sometime back we actually moved to 4 trillion. Okay, and we are pretty sure, since you really asked me 3 to 5 years. So clearly, after 3 years, when we really, I think most of our investor would really look at India at least maybe 5 trillion economy, and that would really mean huge in the global context of things. One of the reason why that 5 trillion is going to be very important for India, because the size of a 5 trillion would really mean that there won't be many eyeballs which can really afford to not really look at India. So clearly, in today's environment or sometime back, you have maybe number of entities or maybe companies which were not really looking at, because the size was not really as large as they really wanted to. Today, China became maybe some few years back became a favorite place for maybe most of the foreign companies, only because they had those size. So the moment we really achieve those size, it has a lot of meaningful impact on us. So that's one. And of course, this 5 trillion is going to go to maybe 6 trillion in over 5 years or 6 years around. So that's a significant number that we would really have. So that's one. Second one, there would be humongous opportunity for maybe investor to really make money, because clearly there are certain pockets of India which is just coming to in terms of maybe going to give a lot of opportunity for us. There are new segment which is actually emerging, and those new segments in the market could really give you a lot of potential in terms of ability to really make money or multiply money. So we have a humongous opportunity as a nation for all of us to really be a beneficiary of it, and it would really of course going to pan out over maybe next maybe 3 to 5 years, as you rightly said.
Okay, Niraj, unfortunately time draws to a close, and we'll have to bring down curtains for this wonderful chat that we've had. But nevertheless, from you, the main points have been banks, private sector banks look good. IT looks good after a space of 2-3 quarters, and of course there's a wonderful rally unfolding in the manufacturing space as far as the Indian markets are concerned. And tighten your seatbelts, 23,000 is coming on the Nifty as far as Niraj is concerned, sometime same time next year. Thank you so much, Niraj. What a pleasure having you over.
Thank you so much. Thanks so much.
Okay. That, ladies and gentlemen, was Mr. Niraj Kumar, the CIO, Chief Investment Officer of Future Generali India Life Insurance. He manages 15,000 crore rupees in the Indian capital markets and retains his bullish stance on Indian capital markets. We've seen 20,000 being crossed on the Nifty in today's session. In fact, it's consolidating at these levels. A record high is probably on way, and this is capped by this wonderful listing of Tata Technologies today at a premium of about 163% to its offer price of 500 rupees. Stay glued to Business Today Television for all your financial news needs. We'll be back shortly.